Hey, it's Rav. Welcome to the Everyday Investor TV show. This show is designed to help us grow our money. You see, the challenge often is that we take our precious time, we go to work, and if we do go to work, we are blessed. We receive a paycheck in order to eat. Let me say that again. We take our time, we go to work, we make money so that we can provide for our family. But imagine a life where money could make you money. You could work a little less if you wanted to, and then you could spend that time with family, friends, engage in a purpose greater than yourself. Every single week, I have an expert guest teaching their vehicle of investment so that you could be nurtured, so that perhaps if you wanted to do the same thing, you could. We are so grateful for you to be able to watch the show. Don't go anywhere. We'll be right back. Coming up, we're talking to our good friend Adrian, and he's teaching us how we can make money investing in the BRRRR Strategy.
We've partnered anything as small as a duplex, and our biggest acquisition and joint venture partnerships has been a 47-unit purpose-built apartment building. And like you mentioned, Rav, everything in between, from 2 all the way up to 47.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commission. Head over to our website, everydayinvestor.com, and find out more.
Hi, it's Steve Aho at Canada's Mortgage Choice. Like many of you, my wife and I, we thought that shopping for a mortgage meant we should look at rates, and rates were the most important thing to look at. As our mortgage maturity has improved and we've learned more about mortgages, we've discovered that really what's important are the terms. The terms that you get with your rate are what you should really consider. There's variable rates, there's fixed rates. Something you should know about fixed rates is that there are always going to be exit penalties if something happens in your life. If you want to know more about how to evaluate a mortgage and determine which strategy is best for you, please give us a call at Canada's Mortgage Choice.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more. Hey, it's Rav. Welcome back to Everyday Investor. We're talking to our friend Adrian, and we're talking about how we can grow our money by partnering with experts such as EPC. Adrian, it's great to have you on the show. Thanks for taking time out and joining me.
Yeah, cheers, man. Thanks for having me.
Yeah, man, it's good. It's good. I was saying to you just before we were airing, Executive Properties Capital. I was saying, let's find a place where we can put an I in there, so it's we can call you Epic. As epic as your company
Epic
is,
Capital.
We should be able to call you that. But tell me how you kind of got started. What you really do is you guys, do a lot of the expert work, and you joint venture partner with people like Rav who, don't want to put on too much deodorant, don't want to perspire too much, would rather, write a check but be able to enjoy profits 50-50. And so that's kind of your concept. But tell me how you got started, where you like to focus, where do you think things are at today? Just love to hear your wisdom there.
Yeah, it all started for me about 12 years ago. I was a full-time police officer in the GTA. And I started buying my own personal investment properties, which kind of skyrocketed. And financially, after 21 years on the police department, I took an early buyout, took an early pension. I retired from policing, and I really focused on continuing to build on my portfolio, which led me to joint venture partnerships. And predominantly in the Hamilton area is where we focused our energy. And these joint venture partnerships grew our company. Essentially, we're sitting at about 415 units right now. And like I said, I started with, I want to own 1 or 2 rental properties, subsidize my pension. When I put my 30 years on the job, led to, something I never really dreamed of. But yeah, it went well, and here we are. And now we actually have turned it into a full-time professional company where we attract people who want to invest in real estate, who don't want to deal with the tenants and the toilets. And we take, like, our organization of companies takes care of everything, right from the acquisition to the numbers, to the construction, to the property management, refinancing, dealing with the banks. We do it all. Essentially providing a hands-free, hassle-free real estate investment scenario.
So a typical joint venture relationship, partnering relationship is, the expert partner will source the property. Your kind of niche is to buy something that's undervalued or undermanaged, underperforming, and then you show it to someone like me, and I say, yeah, I love it. You show the return on investments. What's the minimum amount needed? When do we get that? What's the exit? And then kind of any risk, we talk about that. And then I would fund that. I'd go on title. You do all the headache work. And then we would split the profits 50-50. That's the gist of kind of what you guys do?
That's our bread and butter. Yeah. Absolutely. Yeah.
And then Adrian, is it, I know it's not, but for the sake of just saying it, is it single families? Is it 10 plexes, 20? What is it all, everything in between? Like, what kind of joint venture partnerships? What are we looking at when we're looking to buy, rehab, rent out, refinance, and then repeat? What kind of properties are we looking at?
We've partnered anything as small as a duplex, and our biggest acquisition in joint venture partnerships has been a 47-unit purpose-built apartment building. And like you mentioned, Rob, everything in between, from 2 all the way up to 47.
Yeah, so let's call it 50 units. So that 50-unit apartment building, that wasn't just one RAV. There must have been 2, 3, 4, 5, 10 different investors coming together that partner with you, yeah?
No, one RAV.
Wow. Nice. That's great. That's fantastic.
Yeah, we were able to secure one joint venture partner for that. And I think, you know what, Rav, I think that speaks to our quality and our reputation, that we have one person that came to the table with several $1 million, obviously, and put that with our company to deploy. So yeah, that was one investor.
And so a lot of times, this is the hold. I mean, this is not, because you could easily, buy, rehab, and then sell. And we would still enjoy some great profits, yourself and I. But you're not choosing to do that. You're buying, rehabbing, renting, pulling money out, and then taking that money and we're doing it again. So is that kind of the strategy? I mean, you mentioned 400 plus units. That's what you said, right? 400 plus?
Yes, sir. Yeah.
How many units do we have altogether?
420 now.
Yeah. So is that the plan? You kind of get the investor out as quick as possible in terms of giving their principal back. And then now both parties get to just enjoy cash flow, appreciation, debt reduction. Is that kind of the ongoing plan?
Yeah, and I look at it this way, and I always try to educate our people. At the end of the day, you have very little to no capital left in the deal at the exit, at the refinance. You're cash flowing. You have debt pay down. You're not lifting a finger. Our companies are doing it all. There really is no need to sell it, right? The longer you hold that asset, historically, real estate continues to climb. Yes, there'll be waves along the way, but we all know the longer you hold real estate, you can't lose, and you're going to make more and more money typically. So when you have no money in the deal, you have debt pay down, cash flow, all these things are happening in the background. Your returns are incredible. So why sell and pay capital gains?
Yeah.
Like to refer to as generational wealth, right?
Yeah.
For your family.
So the of the 400 plus units, how many different dwellings approximately is that?
83.
83. And so share with the viewers a little bit, Adrian, about what a REIT is. And you're not a REIT. These are 83 individual properties with different money partners on them. Some have multiple, I'm sure. If I see success in one, I want to do many with you, if not all. Why not a REIT? First of all, explain what a REIT is, and why are you not deciding to put this into a REIT? Now, I'm sure the investor is grateful that you're not putting it into a REIT because they're enjoying 50% of the profits. But from your point of view, economically, it would even be more beneficial for you to put in a REIT. Why do you decide not to do that?
So at the early stages, obviously, this kind of exploded into something, again, that I didn't expect. I didn't start out joint venturing thinking that one day I'm going to blow this into a REIT. It was always, one or two properties at a time, one or two JVs at a time. And then in 2017, when I left the police department and focused, strictly on growing this company, again, I was still focused on the joint venture structure. So I didn't really have that mindset, although it would make most sense, like you're saying at this point, because of the size we're at now and the experience we have. The biggest, and I think you hit the nail on the head, Rav, in a joint venture structure, that partner has a say in what's going on. That partner owns 50% of the asset. And that partner has a lot more play, if you will, in that acquisition, as opposed to the REIT. They're putting in their X amount of capital. They're let's say promised or guaranteed an X amount of return, whether it's 10 to 20% return on their money. But what we're buying typically is not open to discussion. As opposed to in our structure, I would call you up, Rav, and I'd say, hey, I got this deal. Here are the numbers. Do you like it? We would talk about it, but you have the final say. To say, yeah, let's JV on that deal. I'm in. I have the capital. You and me, Adrian, let's go. It doesn't work that same way with a REIT, as you can, I'm sure you already know that, but that's the biggest difference. I think in a joint venture, the joint venture partner has more of a voice in everything that's sort of happening. Although we're taking care of everything, we're more on a personal level with them, one-on-one.
No, that's great. And when I was back in the day, when I enjoyed making things happen, and I was joint venturing with money partners, I wanted them, they had a say in whether they wanted to do, it wasn't a fund, it wasn't a REIT, this was project specific, and I would show it to them. If they wanted in, they wanted in. But after they wanted in, they invested with me because they trusted me. People are investing with you because they trust you. So you don't want somebody, kind of knocking at your door every single day and saying, hey, what's happening? They trust you to get the results done. Of course, they get to see everything. Everything is disclosed. They can ask any questions, but that's not generally how a joint venture relationship works. There's got to be a trust that, hey, you're investing with me, Adrian, or EPC, or maybe Epic to be. You're investing with me because you trust me. And so if this is not your expertise, you don't really need to know how much the roof cost per se and could we got it cheaper. Yeah?
Yeah, exactly. They're putting, and we have countless examples. If an investor were to come to the table and give us some of your recent projects, for example, and how those numbers played out, we're any typical time we're involved in 8 to 12 projects at one time. So there's tons of examples to show. But yeah, there's obviously, they've done their due diligence. They've done their homework on myself, our company, everything like that. They've asked for referrals and they've satisfied themselves on that due diligence stuff. So now, yes, it's time to, you obviously done your homework. You know that we're reputable, we deliver, and now we do our thing.
Yeah.
Yeah, we're not looking for the guy that's going to ask us, well, could you have gone to Lowe's and bought that toilet for $40 cheaper instead of Home Depot?
Yeah.
No, we're not going to entertain that kind of a.
So Adrian, why don't we let's take a quick break, and then let's look at an example, and then all your information's there on the screen. You're good for people that are watching the show to be able to go into your website, sign up for the deals that come out, and it's kind of
Absolutely.
I would imagine it's kind of like a first come first serve as you send out different projects that your team is looking for. Let's take a quick break, and then we'll look at one of your latest deals, take a look at the numbers so the viewers get to understand really just how great joint venturing with the BRRRR strategy is. We're talking to our good friend Adrian. Don't go anywhere. We'll be right back.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commission. Head over to our website, everydayinvestor.com, and find out more.
Hey, what's going on? This is Kyle here from Kyle Ford Mortgages. On today with my better half, Chelsea. We have a very exciting announcement. You've asked, we've delivered.
We have a really exciting event, so mark your calendars, June 9th to 12th. We have networking, mastermind, some awesome content. We have a pool party, a beach party, a black tie gala. We've got it all, and you can rent your very own cottage or have an awesome room at the Kiwi Motel.
If you're looking for all things real estate, whether it's short-term rentals, long-term rentals, private lending, creative financing, whatever it may be, not only great content, but great people, good times. You absolutely do not want to miss this. Make sure you check out the link.
Everyday Investor, First Access Condo is coming back to the hammer. That's right, we're coming back this week to Hamilton, Corktown by Slate Asset Management. 2 towers, 27 and 24 stories, 700 units. 225 John Street South in Corktown. And why is this so appealing? Well, the biggest problem about being a real landlord in this province is the landlord-tenant board. Now, what if I told you that the vast majority of foreign students like to pay their year up front? Doesn't sound great? Sounds amazing. And how do we get those? By our project being near a university. And what's the biggest university in Hamilton? McMaster. And how close is it to Corktown? A 5-minute walk. That's right, Corktown. 5 minutes from McMaster. First Access Condos. Don't be second.
Hey, it's Rob. Welcome back to Everyday Investor. I'm talking to my friend Adrian. We're talking about how we can make money partnering with an expert partner, if you're the money partner, using the BRRRR strategy, the buy, renovate, rent out, refinance, repeat, because you pull your money out, and Adrian's going to show us exactly how we do that. His outfit has over 400 units, and they're continue to crank long-term, pretty much infinite returns, and we'll explain why. So Adrian, tell us about one of your latest deals here and how the numbers worked.
Yeah, so this is an example of a really successful project, obviously. And at the end of the day, here's an example I'm going to share with everybody that we were able to extract all of our capital, and there was a small surplus at the end of it. So again, infinite return on your money. So in this example, the purchase price was $740,000.
740?
Correct.
And where is this located?
Hamilton.
Okay, so the purchase price, sorry, 740,000. Okay.
Now, down payment, 20%.
Which would be?
$148,000.
48,000?
Which give 148, which
Okay.
gives us a first mortgage of 592,000.
Okay.
We spent a total of $116,000, 436. So 116,436 on renovations.
Okay.
8 months later, we refinanced the property when construction was done, and we had an exit value after repair value of $1,170,000. 170.
Okay, so we bought this property for $740,000 and we put in almost 120. So we're in the deal for 860, and you're telling me that at 860, the refi value was almost 1.2 million.
Correct.
Wow. Okay. So now, so here is the buy, here is the renovate, and then we refinanced, or sorry, I put refinance, but you're just saying the value is that. So actually I should probably, the after repair value was this. This is what market value is today. So again, for you watching at home, Adrian's team bought for 740, put in almost 120, but they lifted it this much to almost 1.2, 1,170,000. So now a lot of people would just sell this, pay their capital gains, and away you go. But Adrian's strategy is a little different. They want to hold this, but we've got to be able to get our money out. So then what happens, Adrian?
So now the bank gives you 80% loan to value
So 80%
on the
80% of this,
1,170,000. Correct.
which is
936,000. 80%, 936,000.
that's how much the bank gave you.
That's your new mortgage, right?
Yeah. Oh, that's your new mortgage. Yes. And then
Right?
I
So
take
now
the.
you have a new mortgage of 936.
Yep.
So then we have to subtract,
Yes.
because now we want to find out how much money are we leaving in this deal.
Okay. Hold on
So
one
we
second.
subtract 936 minus
Yep.
our original mortgage,
Yeah. Which
which
was.
was 592,
Okay.
minus
Yeah.
we got to subtract what we spent on renovations.
Yeah.
116,436.
Yeah.
We have to minus our carrying costs,
Yeah.
25,544.
Thanks for putting that in, by the way. A lot of people would try to project this, but they wouldn't, account for the carrying costs of while we're renovating, so on and so forth. So it was $25,000 of carrying costs. Yeah. What else?
Closing costs. When we bought the property,
close.
we had closing costs, land transfer tax, lawyers, 14,000 in closing costs. And
Okay,
then we want to subtract, lastly, our original down payment when we first bought this property before we renovated it. And if you
Okay.
recall, that was $148,000 down payment.
148.
At the end of the day, we're left with, so you can put a big line underneath the 148,
Yeah.
zero capital left in the deal,
Yeah.
plus we ended up with $40,120 surplus. The bank paid us $40,120 to own that property,
Okay. So
with none of our capital left in the deal.
what we did, we bought a property, we renovated, it has a new value, and so therefore the bank gave us mortgage of 936. We take away everything here. That leaves us with a positive 40 grand. So Rav, if I was the investor in this deal, I got all my money back plus $40,000, which I would split with EPC, and 20,000 to be able to do what I want with. And now this property, it cash flows, it's increasing in value, and the tenants are paying down the mortgage, and we're just going to keep that forever. And then maybe every 5 years we finance it or refinance to be able to pull out more, to be able to split 50-50. Yeah? And this is what you do all day long?
Every day, all day long.
And how many projects are you working on at the same time?
Anywhere between 8 to 12.
8 to 12. Wow, that's great, man. That's great. And is this the continuing strategy? I mean, was there any pivoting in the last year or two or three, or this is what we did? Or if you did pivot, how did you pivot during COVID, during times like this with interest rates skyrocketing because of inflation? What's something that you've done?
We have to, so COVID was great for real estate, as you know, right? Like prices went stupid crazy. So we were pulling out all kinds of surplus on the refinances during COVID because prices just kept going up and up and up. Obviously now prices, over the last year came down. So and obviously where interest rates are today is they've doubled, tripled. So today, as long as an investor today, pre all the bank interest rate hikes, we were cash flowing anywhere between, let's call it $700 to $1,000 monthly on a typical triplex, fourplex, right? In the Hamilton area. With rates today, we're basically anywhere between $150 and $300 a month cash flow. It's really dwindled down.
Yeah.
But I guess peace of mind is there's not too many markets today that you're going to cash flow in the GTA with, the rates where they are today. But hey, if we're still above water in today's rates, when they start to come down and prices start to go back up aggressively, you're gonna look like a genius.
Yeah.
At the end of the day, I think we're all confident to say that I don't think prices will stay where they are today forever.
Yeah.
I don't think they'll go down to, sub 2% again.
No, that's great. And so on a project like this was what? Was this a duplex, a quad? What was this?
That was a quad.
This was a fourplex. Okay. So this was a fourplex. Today, because of interest rates, we're not necessarily making a lot of cash. So do you usually do these mortgages in a fixed 5-year, or do you do variable?
Historically, we've done variable.
Variable, okay.
Especially at the purchase, because you want that variable at the purchase. So when you refi, obviously, you're not banged with a huge penalty.
Yeah. Yeah.
Then after we refi, depending on the climate and what's going on, that would be the time to maybe look at a 2-3 year fixed. Because you're gonna hold this property for a few years anyway. So take advantage maybe a fixed rate after refi or at point of refi when you're renegotiating that mortgage now.
Listen, Adrian, great stuff. Appreciate it. This is recent as, a year or so ago. It's not like we're looking at something 5 years ago. You're doing this right now, continuing to do it in this climate. So for those of you that, want to get into real estate but don't necessarily want to do the legwork, or you have some funds, Adrian's outfits on the screen there, EPC, please continue to get a hold of them. Adrian, time flies when you're being nurtured, having fun. Thank you so much for being on the show with me. Really appreciate it.
Cheers, Rob. Thanks for having me.
Yes. And thank you guys for watching. Without you, we would not have a show. Make sure you go to everydayinvestor.com, sign up for our weekly episodes right into your inbox. Watch this show over again. It's like on demand. Until next week, same place, same time. We'll see you there. And until then, honey, love you. I'll be home soon. Bye, everyone.